Hey everyone, welcome back. It's Finance Fridays. I'm your host, Anthony, and on this week's episode, we're going to break down some of the decisions on why I think the Bank of Canada hit that pause button. Now, there's so many different components to really pay close attention to right now. Obviously, many economists at the beginning of August predicted an upside risk on an increase by the Bank of Canada. But as we saw, some of these economic data points coming in obviously influenced the Bank of Canada to hit that pause button. What were some of those major players and what were some of those major points? But more importantly, many economists are now predicting that the Bank of Canada will have no choice but to increase another at least 0.25% by at some point between October and December. And will we see that actually play out? The truth is, nobody really knows until we get those economic data that's so important to the Bank of Canada. And even though all this economic data that's really being produced is generally backwards looking, meaning that there is a lag in a lot of these different components, well, we have to understand and digest those particular products and look at them. Something we've talked about on this channel is that base year effect of how these numbers will play out throughout the course of the year when you're looking at one data point for month over month from the year prior. So what happened obviously was in the month of August, we got July CPI numbers, which came in hotter at 3.3%. As you recall, maybe you remember that in June it was at 2.8, jumped to 3.3. That gave a lot of ammunition to the Bank of Canada and to economists to believe that the Bank of Canada would potentially increase in September. However, obviously looking at some of the data points within core inflation, which strip out things like food and energy, and those headline inflation numbers, a lot of these particular components were situated in the right direction, or the trajectory at which these items within these buckets were moving were not increasing at the same pace as they previously were. And obviously, because there's a lagging indicator for them to go up as well as to come down, the Bank of Canada may have digested that and said, look, things are happening in accordance with our forecast. The way we wanted things to play out, it is starting to work. Now, obviously, we have to keep in mind that monetary policy works as a lag as well. It doesn't get instantaneously felt by the entire economy. Well, that is unless you have a variable rate mortgage. But obviously, with most of the monetary policy decisions, it takes time for the economy to digest these higher costs, especially when we think about things like savings accounts that were pent up during the pandemic now being depleted. You think about how these interest rate costs are playing in with mortgage renewals, variable rate and trigger rate mortgages. All these things lead the Bank of Canada to believe that their monetary policy rate decisions, those 10 increases that we saw starting from March of 2022, are starting to play out. Remember, they take 12 to 18 months to have their full impact. And because we have so many increases happening, well, it could take even longer for some of the later increases to actually be felt in the economy. So we have to keep a very close eye on those particular elements, as well as what's happening with GDP. I think GDP was the biggest mover and shaker for the Bank of Canada to hit that pause. So what actually happened? Well, we saw a contraction in GDP of about 0.20%. And obviously that means that the Bank of Canada's misalignment with their projections and forecasts, which I believe were around 1.5% or 1.7%. And obviously with the fact that it came in lower, this puts the Bank of Canada in a position where it has to take that data and say, okay, well, we should really assess what's happening, because if the economy is contracting, our desired impact by raising rates is starting to really weigh in. How much it's weighing in has yet to be determined, and that's what I think scared the Bank of Canada into this position of really pausing. So what were some of the things within GDP that really impacted the Bank of Canada's decision? Well, you have residential real estate investment, you have consumer spending, and obviously things like the wildfires that are happening within Canada. But I really think if you take a look at, number one, consumer spending first, obviously that's having a desired impact by monetary policy. So many Canadians who have variable rate mortgages, who maybe had some savings, obviously now that's dwindled out. Many Canadians might be taking on debt to service their mortgage. That's being reported through Equifax. We're starting to see some Canadians missing those credit card payments, not as much in the primary conventional mortgages just yet, but obviously that means that the cost of borrowing has gone up, and consumer spending, credit creation, mortgage origination are down. Remember, the easiest way to introduce new money into the economy is through debt or through credit. And obviously, as that gets more challenging, while we're not creating new money, that's money less spent in the system. Canadians who don't have the savings are depleting their savings, borrowing money, or maybe don't have the access to new credit. Maybe they can't get lines of credits anymore. They can't get new credit cards because maybe their credit is a little bit weaker. They're already over leveraged. All these things play into why consumer spending is down. Not to mention the fact that a lot of Canadians might be finally listening to the Bank of Canada and saying, hey, you know what? Let's cut back on some of the spending. We don't need a lot of these things to survive. We just need the bare basics. And then we look at residential investment. Obviously, that's home creation, right? New home building, renovations, and you look at home transfers, title transfers, what's happening in that space. And obviously that's down significantly from previous years and months. And obviously with that finally pulling through, well, the Bank of Canada is looking at this data positively. And obviously we have this conversation around new construction homes that are obviously down. And why are they down? We have immigration at all-time highs. They need to be building. And I do agree with that. Yes, we should be building, but unfortunately, we can't really force the builders' hands. Even if they were forced with a penalty, they might choose to pay that penalty because of the fact that it just doesn't pencil. It's cheaper for them to pay maybe a penalty not building than it is to build, because obviously many Canadians don't qualify to get a mortgage today. Let's just call a spade, with the reality of interest rates with a 6 in front of them on most products, unless it's an insured or insurable product, maybe with a high to mid 5% range. Obviously, many Canadians who can't qualify, it's at 8%. So that means that builders who produce a product, even if it's a condo with a cheaper barrier to entry, the incomes to support that need to be relatively high. And Canadians who are looking to buy need to be qualified to buy. And with all this volatility happening in the housing market with interest rates, well, a lot of Canadians aren't ready to buy just yet. They're waiting. Maybe they're waiting for the Bank of Canada to pause. A lot of Canadians were on the sidelines just waiting for the Bank of Canada to make the September 6th announcement. And that could force many Canadians back into the market, as we saw back when we saw the Bank of Canada pause previously. You know, more people enter the market. Interest rates came down relatively significantly compared to where they are now, obviously much lower than now, but obviously we saw more people go back into the market. So how is that going to play out moving forward? And then what we have is global economic pressures. I think these are some major players for the Bank of Canada. At least in my opinion, I'm paying very close attention to two particular elements. One is the US, obviously our biggest trading partner, what's happening with the exchange between the Canadian and US dollar. When you think about importing inflation, if the Bank of Canada doesn't raise the rate to the same level as the US, well, obviously that means that the currency difference is going to be much larger between what the Canadian dollars with the US dollars, and that means we're buying goods obviously at a higher price, which means, well, that's going to cost us more and inflation will go up. Then you have obviously the dynamics between our two economies and what is happening, why the US can raise more than Canada, maybe putting Canada in a position where the Bank of Canada is forced to meet or match the US, and where they just can't, because obviously the amount of leverage in the Canadian system, especially when it comes to consumer debt, is at an all-time high. You have differences in their mortgage structure. Obviously Canadians renew their mortgages every 3 to 5 years, making them more susceptible to volatility in interest rates. They're more sensitive to interest rate adjustments than they are in the US, where their mortgages are renewing every 30 years. And even though in the US the mortgages are portable, that's holding more Americans in their homes, as opposed to Canadians who might be forced to sell if the inventory changes, their financial situation changes, obviously the two dynamics. And I think the biggest underlying factor, we've had this conversation on multiple levels with clients, was the deleveraging that the US had gone through in 2008 during the great financial crisis. I'm sure many of you have seen The Big Short, but obviously this is what we're talking about. We're in the divergence between what happened in 2008 when the Canadian and the US governments and the economy and the Bank of Canada and the Fed brought interest rates down, and there's a different way of spending. While the Canadian economy continued to tick upwards, home prices continued to accelerate, Canadians continued to take on debt, as the US continued to maybe face these challenges head on. So there's two divergences happening right now. But I mean, let us know your thoughts about that in the comments section below. But the biggest one is what's happening in China. China is the big underlier right now. And we've brought this up multiple times, and it's been in almost every single Bank of Canada update when it came to monetary policy, but now more so than ever because of what's happening with their real estate development and the fact that it's falling apart. China's economy is really facing some significant headwinds. Their central bank has pulled back on rates, their economy is contracting, and the impact that that could have not only here in Canada, but in the US and across Europe and the globe is obviously monumental, because China does produce products for everything. But obviously what's happening with the real estate, is that going to push the biggest real estate market globally, arguably, to the ground? And will that create more room for investment in other countries? There's obviously a bearish and a bullish case for this scenario. But obviously how this plays out will be yet to be determined. And that's why it's very important to understand that our decisions or our economic outlook on what happens next with the Bank of Canada is so volatile. It can be literally changed from week to week, month to month. But obviously we said that the Bank of Canada was going to pause in September, not because I have a crystal ball, but obviously when you look at the economic data, you start to see these trends and what the Bank of Canada is looking at and what they want to see. And if they get what they want, well, it looks like the Bank of Canada is going to do what most variable rate mortgage and trigger rate mortgage clients want, is hit that pause button. And I know this is in juxtaposition to a lot of people where we hear and see in the comments who, no, we want interest rates to go up and we want home prices to crash. Well, if a recession comes, depending on the severity of that recession, how many job losses we see, I think unemployment's at 5.5%. Wage growth is around 4 to 4.5%, 5%. Bank of Canada wants that to come down. Obviously, all these open job vacancies come down. Obviously, immigration playing a hand at sort of fluffing up these numbers here in Canada. And remember, we are pro-immigration. Obviously, immigration has a benefit to replacing the aging population, but it does skew these numbers when it comes to the Bank of Canada. And obviously, the reporting with Stats Canada, we talked about last week with Benjamin Tal. Like all these things playing into each other, obviously going to influence the Bank of Canada's decision ahead of October 25th. So I guess if you had to sum everything up to bring this thing full circle, obviously we know that the Bank of Canada made a decision to pause. I believe it's a very good decision, because obviously the volatility of things that are happening with contraction, China, US, obviously currencies, obviously what's happening with core inflation, the trajectory, monetary policy, qualification stress test, building, all these things. If you take them as a whole, obviously there's probably some things that I missed. Let me know if I missed anything in the comments section below. But obviously we have to understand the Bank of Canada did do a wise decision to pause. Whether or not it's enough, or if there's going to be enough data to support a continual pause, or if that's it for the Bank of Canada, I think there may be some think that they're done. Obviously, some economists saying 0.25% by the end of the year. Let me know in the comment sections below what you think. Will we see another 0.25% by the end of the year if things don't improve? Will the Bank of Canada be forced to raise policy rate, or is that it for the Bank of Canada? Are we done seeing these rate hikes based on contraction and recessionary fears? Let me know in the comment sections below what you think. But until next week, thanks for watching. Thanks for clicking. Hope everyone has a great Friday and an even better weekend ahead. We'll see you next week.